Hi, my name is Adam Stern. I'm CEO of Strata SFR. We're a build-for-rent and SFR portfolio brokerage. Wanted to talk a little bit about the pending interest rate hike that could be happening when the Fed convenes for a meeting. I'm not an economic expert. I'm certainly not an expert on interest rates and how they affect the overall federally backed loans or short-term treasury backed loans. What I can speak to is what my take is on what might happen and what has happened over the last several weeks since the previous interest rate hike on June 15th, where the Fed raised the Fed rate 75 basis points. The drum being on the street right now is that we could be seeing an interest rate hike by the Fed of as much as 1%, which is a huge jump. It would be the biggest jump in the last 30 years. Last time they increased interest rates, we didn't see a lot of buyer sentiment change because the increase in interest rates just didn't happen yet. So buyers were buying hot and heavy in most markets where most institutionals have the most buying activity going on. We saw cap rates for portfolios that were higher end A-class portfolios trading in some instances going in cap rates below 4, stabilizing to mid 4 cap rates. And that continued to happen until the last interest rate bump. What happened after the last interest rate hike, as usually happens, buyers change their buying habits before sellers get the message. So what we saw on the SFR portfolio side is that funds had a more dimmed outlook on home price appreciation and a little more dim outlook on rental growth. That facilitated them needing better prices from our sellers, and their cap rate requirements, which ranged anywhere from between high 3 cap rates to low 5 cap rates, depending on the kind of assets they were buying, actually bumped up over the last 7 weeks of activity after the last interest rate hike to now, when we're pricing portfolios, the guidance that we previously gave to sellers, which was price your portfolios at market, we'll create competition for it, and there's a good chance you might end up getting above what we think is retail value. In a lot of instances, we ended up getting some margin above asking price by putting funds in competition for those portfolios. That ain't happening anymore. What's happening is buyers are now needing to account for the extra added risk of potentially higher financing costs in the future and this dimmed outlook on the overall real estate market, which washes out for sellers into needing to price their portfolios lower to achieve a higher cap rate. So over the last 7 weeks, we've seen prices go from us pricing portfolios at 100% of retail value and getting offers some margin below that level, call it 95%, around 95% on average of asking price. We had a tough time making deals, but eventually sellers kind of got the message that things weren't going to get better, things are likely to get worse as interest rates continue to climb. And now that we're on the heels of potential another interest rate, the effect that's having on buyers currently is they're all thinking they're likely to adjust their buying habits to need even higher cap rates, which means their offer quality will end up going down. None of us know this, and none of us knows what's going to happen with the interest rate, but at the end of the day, if you're in an environment of fear, a lot of funds either pull back on buying altogether to see what's going to happen, or some funds continue to buy through the change, adjusting their criteria and offer quality down. This situation is really no different. I expect if interest rates do climb again, some buyers will plow forward with their buying strategy to get an edge in the competition and pick up some loose inventory. Other funds might continue to hold off on buying at all. I think across the board, what we're going to end up seeing is lower offer qualities from buyers. And eventually, I think sellers will get the message and start coming off their pricing, not only accepting lower offers as time goes on, but also being willing to list their portfolios for more reasonable values at or some margin below current retail values. So we're in a funny environment. Everyone's cautious on the buy side. That cautiousness is going to translate into sellers either being sellers and adjusting pricing or deciding to hold their portfolios or build for rent projects for a bit longer and finding an exit a little bit further down the road when we're on more sure footing. Just my 2 cents. Thanks for listening.